Hey everybody, Preston Brent here with our weekly roundup. This is for the trading week ending May 10th, 2019. Well, dangers in denial. I think that's where the big risk is here. But before I jump in, we've seen pretty much most of the global markets sell off all this past week. It was for the U.S. markets anyway. It was the biggest weekly drop for the year. The Dow was down a little over 2%, 2.12. S&P was down again over 2%, 2.18. The Russell was down 2.54, and Nasdaq, brought everybody down. It was down a little over 3%, 3.03%. Of course, the VIX this week was really up over 24%. Where we came into close, it was 16.04, but it was a lot higher than that during the week. Last week, I might add, it was up just a little bit as well. But looking at world markets, the Asian markets took it the worst. The Nikkei was down over 4%, 4.11%. China was down 4.52, which we would expect. And then over in Europe, the FTSE, the London markets were down about 2.4%. The CAC 40 down almost 4% at 399. DAX was down about 284. So, we've had a pretty horrific week as far as market trading goes. The worst sector performer this week in the U.S. obviously was technology. The best performer was still underwater, but that was utilities, only down 73 basis points. And then just looking at all this drop here, if we look at the forward PE ratio, right now it's down just a little bit from last week. It's down to 17.08, so still slightly elevated. And the trailing PE ratio this time last year is 22.05. So that's a 5-point difference in the PE ratio. So that shows you how much analysts have taken down forward guidance from over a year ago. Now, one of the things that concerns me is that if we look at the analyst forecast for 2020, they're still elevated. In fact, after this trade tip, they haven't changed much. So analysts hadn't brought down their forward guidance, both for top and bottom line growth. They're staying the same for 2020. And, every analyst, just about all analysts believe that this trade war is going to come to a conclusion here pretty soon, which is, if you're not in a cave or on the holidays, that's what brought the markets down with Trump's tweet on Sunday talking about, immediately tariffs are going to go into effect on the additional 15% on the 200 billion, which did go into effect at 12:01 a.m. early Friday morning. And then he threatened again an additional 25% tariffs on the remainder of Chinese imports. I think it's like 325 billion. And the next time that both Trump and Xi are scheduled to meet is going to be at the Group of 20 meeting in Osaka sometime in June. I think it's like second or third week in June. Not sure of the date yet, but that's their next official meeting. And China, what I'm seeing from all the analysts, just about everybody is overly optimistic on a trade deal getting done because every analyst, and if you look at TV and the talking heads are all saying the same thing, neither party can withstand the economic pain and hurt that would be caused by just not getting a deal together and then Trump laying another 325 billion subject to 25% import tax. So think of it this way. Everybody's overly optimistic. And when the markets get too heavy on one side and then the markets don't do that, then it is a reckoning, as we saw on Monday. When the markets, as of going into close on Friday last week, everybody on the Trump negotiation team was very positive until a cable came in to the White House Friday night with the marked up negotiation points, and it looked like China had reneged on just about every one that they agreed to. So that caused a mass reversal in the markets this week. But it's going to get a lot worse. It'll look like the month of December if they can't reach an accord and then Trump slaps 25% on the remaining Chinese imports of 325 billion. So with the markets overly optimistic that the deal's going to get done, then we've got to be very careful here. Okay. So that's a little bit about what I'm kind of seeing out there. Everybody is just overly optimistic on that, as evidenced by the analysts not taking down the 2020 revenue and earnings forecast. Okay. Um, we're currently right now, I think the markets are kind of in this Goldilocks scenario. It's not too hot, not too cold. The Feds are kind of on the sidelines right now. There's really no need for them to do anything. But, the bond market may get its wish because the bond market has forecasted since Q4 of last year, there's going to be the chance of a rate cut is higher than the chance of a rate hike. And if we do get this trade tiff that hits the markets, then you're going to see the Fed's probably getting ready to cut rates by 25 basis points. And what that does is it pushes more money into the equity markets because it reduces the interest that big money can get sitting in a bond fund or something like that. So we'll see interest rates go down should that happen. And what really kind of sneaked across the horizon this past week, only briefly, was that the 3s over 10s. The 90-day interest rate actually moved higher than the 10-year yield briefly. And then we came back in line again, moved back up above zero. But if you guys remember in March of this year, 1 week in March, every day was a down day because the 3s over 10s. We had the 3s over 10s for, about 4 or 5 days before it got better again. Now, anytime we have a yield inversion, whether it's the 3s over 10s or possibly the more popular 2s over 10, which is the 2-year interest rates moving higher than the 10-year interest rate, it generally forecasts a recession anywhere from 8 months to about 16 months out in time. So even if that does hit, I've shown our members in our weekly market watch sessions, I pull up the charts and I show them where the markets always tend to move higher. On the initial submersion below zero, markets sell off a little bit and then they start moving back up again before it really sells off. But it does give you a heads up notice. I think right now the markets are kind of a little bit over optimistic on the Trump trade deal with China. If it happens, great. But even then, growth is going to be a little bit limited. And I still am sticking to my belief and just looking at the charts that the upside is going to be limited. And the risk of a bigger move is not upside move, but it's going to be downside move. Okay. And I guess maybe this summer was probably the best time to do the sell in May, go away type of thing. It may bear fruit, but we'll see. If they get a trade deal done in the next 60 days, which is what the markets seem to think is going to happen, it'll be drawn out just a little bit. But, if Trump comes out with another tweet, he's already now put 25% on 200 billion, and then there's another 325 billion, which would take us up to just about all Chinese imports of 525 billion at a 25% rate hike. What he may do is instead of say 25% on 325 billion, the additional that's coming in tax free now, he may say I'll do 10%, and then I'll bump it up another 15% if we don't get a deal. I mean, we'll see what he wants to do because who knows how he's going to play that. But that's where I see the risk, guys. And it's one of those things where it's a binary event. It's hard to call. So you've got to be wary of that kind of thing. You could be, doing really well in whatever you're holding, and then the next day everything changes. So you probably want to go a little bit more to cash, or hedge a little bit more on the downside until this thing is resolved. And it may draw out 30, 60 days, or it may go out 6 months to a year. Okay. But one way or the other, it's going to get resolved. Either the deal's going to be done or a deal's not going to be done. The other thing I find really interesting, if you look at the S&P, and then you look at the high-flying tech stocks, and I'm talking about Facebook, Amazon, Apple, Google, Microsoft, those guys, just those stocks right there account for almost 16% of the movement in the SPX. They're huge cap weighted, and they really drive the SPX around. Okay, but look at the futures, the Nasdaq 100 futures. Remember, there's only 100 companies in the Nasdaq futures, and I know it's a popular trading tool too, trading NQ. But those same stocks, the Facebook, Amazon, Apple, Google, Microsoft, account for almost 45% of the movement of Nasdaq 100 futures. So when you're trading NQ, you're essentially trading the FANG stocks. Really, that's all you're doing. I mean, when they're having a great day, Nasdaq futures is having a great day, and vice versa. So that's why it's always fun after markets close, if Microsoft, which is the largest cap weighted in Nasdaq Futures right now, or Facebook or Amazon, any of those come out with earnings after markets close, just day trade the Nasdaq Futures, because if they bounce up, then you're going to get the sympathy move with all the other FANG stocks, and then Nasdaq's going to follow along. Okay, but that's a huge weighting. And then if you look at the Dow, only two stocks account for about 14.5% of the entire Dow movement. That's Boeing and Apple. And both Boeing and Apple are tightly interwoven with China and how China trade deal happens. So that's why the Dow tends to be a pretty good little mover. It bounces around a pretty good little bit around any good or bad news coming out of China. But again, those two stocks pretty much drive a big part of the Dow. So you got to understand what's moving these things around. And typically, when we see a market that's moving up nicely, in other words, it's a Goldilocks market. Money is kind of enjoying it because when you have a Goldilocks environment, the Feds are on pause and so forth. Those stocks that tend to perform better are the higher beta stocks or cyclical stocks or technology stocks. They tend to trend the best when you've got the kind of environment that we have now. But when you have a shock to the system, these very same stocks are the ones that get hit the most. Okay. So that's a little bit about where we're sitting right now. I'm not going to try and forecast whether this trade deal gets done or not, because that's crazy. You can look at just about any business channel and you're going to get most of them saying that it will happen. There's a big debate on when, okay? But most of them are saying it's going to happen. But I always look and say, well, what happens if it doesn't get done? What if it just ends? Because Trump will do it, right? It'll crash a lot of things and then markets will settle down. They'll recalibrate the forward PE ratios. And they'll come down substantially, so that will cause a hit. The U.S. will suffer the least, China will suffer the worst, and then depending on how the retaliation comes from China, that could put some more umbrage on the markets. But that's kind of what I'm looking at right now. If you look at the screen right now, it's a weekly chart of the S&P 500 E-mini futures. Okay, and just looking at the chart, you can see on this regression channel, we came right in and we closed right on the regression channel. And this is off the December lows down here in the lower left-hand corner. You could see we're not that far off the all-time highs for the E-minis. We've got a huge solid support point right down in that area there. In fact, I've got a pivot high that we breached back in late March. You can see this red line here on that pivot high. That's right around the 2,800 level, okay? And at the 2,800 level, that would give us about a 5.4% pullback from the all-time highs. Now, we've been on a tear this year, just a huge run up. So, a pullback of 3 to 7% is normal when we've been off to this fast of a start. And pick a reason why the markets pull back. I mean, this one was clear. It was the Trump tweet. But, there's probably people more willing to sell on any bit of bad news or any news that could, change the outcome of a global forecast going forward about 6 months or so. So we sold off. This is, in my mind, a really good area of support, 2,800. And if we take it down to about 7%, that puts us in right about that area right there, right? Now notice my value area, that little yellow bar that's sitting out here, that's where the most volume took place going back 90 bars. That would be the past 90 weeks, a little bit over a year and a half, sitting right at around, in this particular case, sitting right around 2660, 2650 area. And that would give us a 10% pullback down in that area right there. Okay, and then this area right here would give us about a 7% pullback. And then the 2,800 would give us a little bit over, let's call it 5.4% pullback right here. And the reason why I'm doing this is you can have these levels of pullbacks, 10%, 7%, 5.4%, and that's not a big deal in a bull market. In fact, generally every year you get a 5 to 7% pullback, and 10% pullbacks are not uncommon either. They happen often, believe it or not. So in a bull market, and that just what it does is it's the pause that refreshes. It gives more money to come in. There's still a lot of cash on the sidelines. Over 30, 40, 30%, 35%. If you look at the studies from mutual fund industry and some of the big money, they estimate, no one really knows for sure, but estimates based on volume and cash flows from the big funds, that about 30% is still on the sidelines. I think a lot of money is waiting to come back down into these areas down here to buy, right? They just didn't buy on this big move here only because we were doing that big move down here in Q4. So money got out and it did not come back in. So money not coming in here, as you know, FOMO, eventually, it's a human condition that there's no pills to take to try and calm it down. Fear of missing out. The higher it goes, the more people start coming in at the latter stages of a real voracious run. And then when it comes down like this, down to this area here, it flushes. Generally, the ones that get flushed out quickest are the latecomers right here. They're stopped out. The ones that have gotten in long back down here, they're still in it to win it, and they may take some out, but not all of their positions. So when you get these pullbacks of 10%, 5 to 10%, they're healthy for the markets. And it allows more cash to come in. Why? Because the cash that's on the sidelines will see once it starts moving up again, they're going to say, well, I missed the move back over here, but I'll be damned if I'm going to miss the move right here. So human psychology being what it is, fear and greed, they're going to come back in here probably in an interesting way, and that'll give us the next impetus to go higher. Now, if we do not get a China trade deal, okay, now remember, most of the markets expect a deal will happen. The issue is going to be how long is it going to take and how long will people wait? I don't think it's going to take too long for people to understand what Trump's position is going to be. If he does put tariffs on the extra 325 billion, right? Remember now there's 25% on 200 billion, so all he's got left is 325 billion. If he puts extra tariffs on that, then you're going to see the market sell off and we're going to come down below the 2018 close and we're going to be heading down in that direction right there to test these lows in December. So that's a bigger move, right? I mean, you're talking about a 400-point move in the S&P. In the S&P, guys. And that'll take out our 2018 if he does that, because then China is going to retaliate. And then there's a lot of debate on just what can they do to retaliate, but they will not start selling bonds, U.S. bonds. That would be suicide for, that'd be like playing Russian roulette. They won't play that game because it'll destroy them more than the U.S. A, they will take a hit in the bonds that they hold, and B, it'll cause major currency fluctuations on their part. And then you remember about a year or so ago when they had major currency people, big money, taking currency. They were selling the yuan and buying the dollar and the euro to get out of China, and China had to put a stop to it. They put a limit to what folks could do over there, and that caused major problems in China. So they're not going to sell the bonds. I mean, I hear that, and that's just, they're not going to do that crap. But there are a lot of other things that they could do, right? So if Trump goes with that next round of 325 billion, we're gonna be playing south of the 2018 close, which means the S&P will be in the red. So will Nasdaq. So will the Dow. The Dow will probably take it the worst. Now, the markets aren't forecasting that, so just understand why. And I'm not saying that's going to happen, but generally the markets move the most when something not as forecasted or not expected happens, like the Trump tweet on Sunday. Okay, and even then, based on a lot of what I saw on TV and some of the talking heads on TV, talking to some of my friends, they go, "Oh, that's just how Trump negotiates. He does this stuff at the last end to yield some extra concessions." But guys, I'm telling you, if he does do that and he comes through and he just says, screw it, we're doing those tariffs, then it's going to get a lot worse. But for now, the markets are probably going to open next week and be more of an upside mine. I mean, he's talking about, wonderful, beautiful letter from Xi, and I'm sure he'll come out with some other tweets to try and, keep the market where it is. But we'll see how this thing shakes itself out. If I come back to a weekly chart, you're going to see on the E-minis another interesting thing. We did break the regression channel on the weekly chart. I mean, on the daily chart. For the weekly, we're at the bottom. You can see down here the value area is around 27.93. This long yellow bar here that goes back 90 bars or 90 days, or essentially a rolling quarter. Okay, and that is very close to the 2800, which is also a value. An area for the weekly. So we've got a lot of support down here. If we break that, then we're going to come down and test the 200 real quick. Look at the movement around the 50 EMA. Okay, the 50 EMA, exponential moving average. You can see here is the red line. You can see every day we were fighting with the 50 EMA. You know, here we touched it and moved higher. We touched it, we moved higher. We touched it, we closed above. Here we went, or actually we went below it in these last 2 days, Thursday and Friday, but we always managed to come up into close. Okay. And if you look at this daily bar right here on Friday, that's a very, very bullish bar, right? It's a bullish engulfing pattern, in fact, because the low and the high in this bar is higher on the highs of the previous day and lower on the previous day. So that is very bullish. And that came about as a couple of Trump tweets, and the tweet came out, or leaks came out, that the negotiation team on Trump's side is going to go over to Beijing sometime in the next couple of weeks, maybe even next week, but no later than 2 weeks, to try and bring this deal to closure. I think Trump will get on the phone. So we're going to get a pretty good idea over the next 4 weeks. And again, the markets have got about an 80% chance it gets done. So just understand there's that 20% chance it can get real ugly. So just keep that in mind. But you can see how we're closing above the 50 EMA. Should that break, we're going to come down and test the 200, which is at 27.78. And market momentum being what it is, it can always go a little bit lower, right? And you can see the value area on a daily chart is sitting just above the 200 EMA at 27.88, and the 200 EMA is at 27.79. So it's pretty darn close, right around the value area where most volume took place. Both bulls and bears basically came in equal. Okay. So that's a little bit about what I'm seeing there. If we look at the Russell, because the Russell's another one that I want to see hold up really well. And let's just step it out for a weekly so we can get a little bit of a better view here. You can see here the Russell came up near my target. It was a lesser degree 5-leg Elliott wave 5, but you can see the 3-leg here. It's a 3-leg. We took out the prior high here, so that converted it to an Elliott wave 3-leg just makes it a little bit more bullish. And we broke out of this. You can see volume and price action hitting our value area several times on this weekly chart. Okay. When we actually made, let me just go into what's really interesting on a daily basis. We actually made a new all-time high, or a new 2019 high on Monday before the markets got really chaotic on May the 6th. So it's really, and again, on the daily, you can see how we went below the 200 and the 50, but we always managed to close above. And we got a bullish engulfing pattern on the daily play on Friday as well. And then, of course, if we look at the Dow futures, you can see a lot uglier, right? I mean, we got a bullish engulfing pattern, but the chart looks a little bit uglier. And as I told you, some of the big drivers in Dow, like Boeing and Apple, run about 15% of it. And the Dow chart just does not look as clean and as strong, and it will get hurt very badly on this. If I put it on a weekly chart, just to kind of step it out a bit, you can see right here we're in my pullback zone. These bars here are generated through Fibonacci and Gann, and it came right into we're almost right in the center of where a natural pullback would be. And we went up to my pivot point here, and then made 2019 highs, right? And then boom, away we went. So we're not that far away from just really cratering down to the 2018 should these trade deals start to falter. I do not have any divergences, so that would seem to indicate that the markets right now in big price action believes they're going to work this deal out. So we've got to be really careful in case they don't, because the surprise will be very painful. And then finally, if we look at the Nasdaq futures, of which those stocks I told you about, the Facebook, Amazon, Apple, Google, and Microsoft account for about 45% of this thing, right? And you can see we made a new 2019 high and an all-time high. We took out these prior highs here. All right, and then we're now kind of working off some of the steam here in this. There is no divergences in this, so this would suggest that this thing is the pullback will be less limited in this, and we can expect it higher should they work out these issues. Okay, so that's a little bit about what I'm looking at here. And of course, if we look at volatility, you can see here this huge bar. It's a weekly chart. We moved up to, the high here for this past week was 2338 in the VIX. And if we look at it, you'll see it came all off as we went into Friday right here. I mean, the VIX was up on Thursday at a high of 2341. And then it went from 2341 to 1604 by Friday's close. Okay? That's about 7 points, right, in the VIX to the downside. We're still in the yellow, so we got to be very careful. And if we look at the term structure and we look at the front month term structure, we actually move back into the green just slightly. Remember, if we're in the red, we're in a backwardation. We spent most of the week in backwardation, and then we move back into the green for the term structure for the front month. So that just means near term, the markets are still believing that, well, volatility is in a normalized mode right now, which means that the markets expect a deal to happen in the next 30 days or less. And if we look at the back month term structure, notice here we're back in the green again, right? I mean, let me just get this off the screen because that's annoying to me. If we look at this, you can see that we're back solid in the green on Friday in the term structure. So the markets have this amped up view that this trade deal is going to be done sooner rather than later, and Trump is not going to come out with his tweet of 25% on 325 billion. And as we've all seen, you can't handicap it. So what the best you can do is prep for it and say where would the markets go if that happens, and then adjust your position sizes and hedges accordingly. Because we're going to know all of this stuff in the next 4 weeks, I believe. We'll have a pretty good clue as to how it's going to play out. And of course, if we look at the bond market, right, you can see in the bond market, obviously it's moved up, right? Up in this area here, I think next week will probably pull back just a little bit in bonds. Interest rates may stabilize, but you can see that this would tell me, this chart, that we're going to have a little bit of a pullback in the bond market. And if we look at interest rates, look at the 10-year. My level for the 10-year was around 2.5, and I called that out back in February, all right, when we were at about 2.75. So we took about 25 basis points off interest rates. You can see here, back in the February months, right up in here, and it actually, when it started running up here, I still said that the downside was going to be down here around the 2.5 area. So now we're sitting actually below that. So this is going to act as resistance, 2.5 interest rates. They're very low here, right? Remember, the bond market is saying the Fed's are going to have to cut rates, not hike them. The bond market believes there is no inflation, there will be no inflation, and inflation is not transitory. The Feds believe inflation is transitory and it will go higher. So there's going to be this battle that's going to be fought out over the summer. And I think a lot of it's going to be based on where the China trade deal goes with the U.S. Because a Fed is on record as saying, should that happen where Trump slaps another 25% on, we'll probably have to cut the rates 25 basis points, just so that, we don't, run the economy off the brake here. So that's a little bit about treasuries. Of course, if we look at the dollar is mostly bullish. You'll see the wide regression channel I have on here. A little bit of a pullback because every time we get to the top of the regression channel, let me put it on a weekly chart, make it a little bit easier to see. You can see here, we've just been in this upward sloping channel here on this regression channel. And every time we get to the top, we always come back to the middle to slightly below, and then it's worth a buy again. So I wouldn't be buying it here. You can see a little bit of the the bearish divergence here as we move higher. So that just means it gets harder and harder to hold this value. Okay. And then if we look at the euro on the weekly chart, it's the same thing, just in the opposite direction. I think the euro is going to go a lot lower, right? And you can see where we are right now. And if I just kind of back it out a little bit, you can see that the value area in the euro that I have is about, I want to say it's about 1.119, right? Right in that area right there. That's a value. That's a value area that we had established back in 2017, which is kind of where the price is. We haven't had these lows since 2017. Okay. I think this thing is going to continue to run down, and also notice that the euro is staying in the lower half of the regression channel. So there's just a lot of bearishness floating around across Europe right now as far as their currencies go. All right. And you know, the GDP forecast growth for all of Europe, homogenized view, is about 1% for the year. Okay. So not very good. And then of course, if we look at the yen is, and let's go back to the daily chart. The yen is a flight to quality or safety in a global market, so we'd expect it to be higher, as it is. It kind of looks like the bond chart. Remember what I tell you. I work with our members on this too. It's very important to understand the yen is a flight to safety on this, and there are many reasons why. I won't go into details on this. For our members, you've probably got a pretty good understanding of why that is. But you know, it's a good hedge when the markets start to sell off. So if that China trade deal does not happen, the yen is a good place to be. Okay, it'd be a, you know, long the yen, euro, on the forex market, or just long the yen if you want. Keep it simple. If we look at oil, well, oil is going to go where the global markets go. And if the global markets have a big sell-off, oil is going to sell off as well. Notice this regression channel. We broke it to the downside. Now we're going to probably go into a consolidation mode for a bit. And the markets just kind of want to see. I don't think we're going to get too much movement in it until the markets get more clarity around the China trade deal. If I increase the size of this just so that you guys can see it here for a minute, you can see the 50 just barely moved above the 200. I call it railroad tracks. So they're just kind of going slightly with an upward bias, but just barely, not enough to mean anything. So it's serving as support here. You can see it's, you know, the markets on this daily chart is closed above this level going all the way back to May 2nd. So about 8 calendar days. It came right down and hit it hard, and then it's just hadn't gone anywhere since. And we're in this kind of sideways pattern. If China and the U.S. do come to an accord and they solve it, then we're going to come back up to the, you know, upper boundaries here in the mid 60s. We're going to be working our way back up there price wise. But again, longer term, I think price is going to come down. Short term, there's a lot of geopolitical risk out there, from Venezuela to Libya to Iran. So that's given a boost to the bulls in the oil markets. Okay. So it's a little bit about that. And then of course, if we look at gold, gold has been really, it moved back up to the neckline again, right? So if I come in here and just step out, you can see this upsloping green line here, which is a neckline of a modified head and shoulders pattern. And as we broke here, it was a short position, but you could see the constant retest of this head and shoulders pattern, constant. But it hadn't been able to get enough escape velocity to come back up. There is a value area sitting at 1295, just below the 1300 level. So that'll provide tremendous resistance. If we can blow through it and get some elevation, then I'd be interested to take another look at it. Right now, I still think the movement in gold is going to stay confined in this regression channel, mostly to the downside, okay, until this is all resolved. So that's a little bit about what we got going on, folks. There's some activity in the ag market, meat market, and some other things that we're looking at in our group, and various sectors and stocks that could be good if the China trade deal goes south, stocks that would be good to play, and stocks that would be good to play if the China trade deal resolves itself in a nice, peaceful manner and everything is happy-dory again. So that's kind of where we're sitting in the markets. I hope you guys have a great weekend. Happy Mother's Day to all of you out there where it's applicable. here in the U.S. markets. Members, I will see you this Sunday night. If you're not a member, I highly encourage you to come in. We're having a fun time here. And we got trades that are working in this crazy market. Have a great weekend. Members, I'll see you this Sunday night. Take care, folks. Ciao now.